welcome to Capital Discussions Market Analysis. We have Jim Riggio and Mark Principato with us. Jim is the owner and principal at Highland Financial, also a partner at Capital Discussions. And Mark is a certified market technician with many years of experience, and I'm sure you'll enjoy his commentary. Before we get started, we do have a little disclaimer that the entire presentation is for educational purposes only. We don't know you or your personal situation or what level of risk is appropriate for you, so only you can determine that. And Capital Discussions is not an investment advisor. So with that, I'll turn it over to Jim, and he can get us started. Jim?
Thanks, Tom. Yeah, I was excited about this. Mark and I had been talking a little bit before we got started, just about views and different things that we were seeing in the market. And one of the things that I had started and we talked about was just this persistent trend upward. What you're seeing here on my desktop is Fibonacci retracement from the 2009 lows through today. The market has been on this run. The really interesting thing is that this line from the very bottom to the Fibonacci that was drawn to Friday, I had drawn this trend line, the same trend line, back in 2011, early 2012. I had originally drawn the trend line from the very, very bottom to the bottom of, let's call it the end of the first wave or so. I'm not the market technician. I know Mark's going to end up talking to us a little bit about Elliott waves. But when you take a look and seeing, well, how much separation have we had from this line over the last several years, if I end up coming in, you can actually see that there's ever so slightly of a difference. We also have a supporting trend line on the bottom that ends up having us move higher in the market. So from a long-term perspective, I was trying to end up taking a look and saying, okay, when do we end up correcting? What I tend to end up looking at is I have a few different things that I'll end up going through. Some of them, okay, the first one is I'll take a look at some of the oscillators that I end up using. I look at a lot of the standard stuff, different moving averages, okay, MACDs, stochastics, RSIs, William percent Rs, and CCIs. And you can see that all of them are up at their top lines. Now, normally, people say, oh, when it hits there, okay, the market comes back down. But you can see that there are long periods of time where we can actually live on the ceiling, so to speak, on those top lines. So even though we're extended, we've been extended now for a year and a half or so, what's going to end up causing us to come down? Is the momentum slowing down? That's the next thing that I always look at. And I have a set of graphs that I end up using for momentum where I'm basically looking at four different things. First thing I'm looking at is a regression channel. Okay, that's the solid lines here. We're in the regression channel. We're in the top half. We're not overextended to the upside. The next thing I end up looking at, the curve lines, are just standard Bollinger Bands. Again, we're in the Bollinger Bands. We're not extended above them where I'd have to worry where we've gone hyperbolic straight up. Next thing I take a look at are DMIs. The DMIs, okay, are actually strengthening, as are the ADXs. So I'm trying to search for something about where things would end up changing. Yesterday, on Friday, the 20th, I was speaking to a friend of mine who is the director of trading at a $1.3 billion fund. And what they end up doing is that they end up hedging the downside all the time. And as we were talking through what I saw in the market, what he saw in the market, it's the same thing that I've seen when we've talked to a lot of our other institutional relationships and clients, and that is money managers are all afraid, but they have to be long in this market. Money managers, okay, that we end up doing a lot of work with one of my relationships up in New York. A lot of money managers have stopped or slowed down the way they were doing their hedging. We knew another billion-dollar client that we ended up having where they were buying the VXX. For those that you don't know, the VXX, I'll end up just pulling it up here. The VXX is basically an ETN that tries to, does a poor job of it, but tries to replicate the VIX. The challenge that they ended up having, and the reason why they couldn't end up using this, is and I'll get into that in just a minute, but is because it does a very poor job of implementing the VXX, because it has to end up using futures. And if I just delete all the studies, you can end up seeing that as the VIX has gotten crushed, the VXX has done even a worse job. If I compare this to, let's say, if I bring up the VIX on top of it, right? I'm in Thinkorswim, so what I'll do is I'll just going to end up doing a compare. And let me come in here, and I'll just compare it to the VIX. Now you can see where the VXX, okay, started up here, and where the VIX was at 13. You can see what ended up happening to the VIX, how the VXX has just come down. The same thing has happened for the more traditional way, okay, that money managers used to end up hedging, and that would be by simply buying puts. By buying puts, they'd have their downside protection. Well, you can see with the VIX, okay, trading at a 10 handle, that there isn't this huge demand for puts. A lot of money managers just gotten sick and tired of wasting money buying puts. A lot of them have adapted what I would end up calling a just-in-time hedging methodology. I'm not going to end up buying puts because I lose my money all the time. I'm going to end up not buying, and the money that I'll save for not buying them for the next 3 months, the 1 month when I do have to buy them, I'll pay a little bit more. I'll be ahead of the game. Now, here's the problem. There's this herd mentality, and they've all done the same thing. So when the market comes, any type of a correction, they're all fearful, and they're all getting very close to the emergency exits, but what triggers it? You know, what's going to be our Archduke Ferdinand moment that's going to end up sparking, okay, a sell-off? You know, in the macro picture, Mark and I were talking about it, probably the single largest issue in the market today is the debt, okay, and how the debt has transferred. When you think about what caused, okay, the 2008 meltdown that we had, Mark and I and Tom, we were all talking about, do you remember which bank ended up going down first, okay, with all of the mortgage issues? And there were very few people, okay. Mark ended up mentioning how Rubini was one of the few folks who were talking about, look at this debt issue. There was a huge issue going on. A friend of mine happened to be going through a Columbia Business School at the time, and he had a couple of professors just talking about how over-leveraged Fannie Mae and Freddie Mac were, and how catastrophic, okay, this could be. But nobody were listening to these guys. And then all of a sudden, and it wasn't all of a sudden, right? When we were talking, it was first Bear Stearns in February that ended up falling. Okay, and it wasn't until September of 2008 when Lehman Brothers went down in September where that was the moment where the market sold off. So we realized that a lot of times we don't have a single item where this is it and everything goes down. Usually it comes in waves. But what's going to end up causing that? I asked Mark if he knew, because Mark's a taxpayer. Okay, Tom is, but he lives in Germany, so I wasn't so sure about Tom.
He doesn't count.
He doesn't count. Okay. I
have a nice exemption for living overseas.
So I asked Mark if he was a taxpayer, and he said yes. And I asked him if he knew, if I took the U.S. national debt and I divided it by how many taxpayers there are in this country, federal taxpayers, does he know how much he owes? And I'll ask you guys, do you have any idea how much you end up owing? There is a website, and do I have it here? Where did I put it? Called the U.S., it's sorry, there it is. It's the U.S. debt clock, right? There's just it's usdebtclock.org, and it shows our $17.5 trillion close to real-time or estimated real-time debt. And then if you come over here, it shows you how much each taxpayer has to pay. $151,000. Okay? Bet you a lot of you didn't realize you owed $151,000. This has been going on for a long time. But what made this significantly worse, okay, around the world, was that as the banks in the U.S. went down, so did we have issues in Greece, in Cyprus, in Spain, to a lesser degree in Portugal and Ireland. And you take a look and seeing, well, where are they, or where are we in terms of the amount of debt that we've taken on? Realize that the quantitative easing programs that we've done in the U.S. and we've kind of exported around the world, basically having the Central Bank of the United States, the Federal Reserve, or the ECB in Europe, go out and buy debt. And what the U.S. quantitative easing program has done, which we are in the process of slowing down or tapering, is that we've gone out and we've bought all this debt, and we've put it on our balance sheet. Okay, how did we do that? You know, if I asked Mark, you have all of this Visa debt. Okay, I'd like you to use your MasterCard to go out and pay your Visa debt. You still owe the money. Okay. Okay. No, nobody's going to end up Mark get away with that. But
somebody's going to pay soon.
Somebody's going to pay. Okay. And so when that day of reckoning comes, and it always does come as an individual, as a country, the numbers are so large, and there's confidence in the market that they can pay back until there isn't any. Okay? What's the trigger that ends up, okay, saying, uh-oh, there's a problem? Like, I would venture to say that not a lot of folks, unless you do you don't have a life like me and do a lot of reading. Mark, I know you're only slightly behind me, by the way. Okay. When Greece had issues with their public national debt, a lot of times we look at things as a ratio. Well, how much is their debt? And, let's face it, Mark's Visa bill might end up being really bad to him, okay? But, doesn't mean anything to Warren Buffett, okay, or Bill Gates, or pick your favorite billionaire. So one of the ways that they end up, we always look at things is that we measure things as debt to GDP. And you can see that the U.S. is at 77%. The amount of debt that we owe is 70% of our annual GDP. Greece was in trouble when they ended up getting over 125, 150 is where they started to end up having some issues before the ECB came in and helped them. Now, they were nowhere close to Japan at over 220. So at what point does the market saying, uh-oh, these guys don't know what they're doing, we're going to end up really, not buying their debt anymore and driving their interest rates up? One of the things that I had looked at for a long time in Europe, was Spain specifically, Spain and Italy. And I worried about Spain and Italy because their debt was going up, their interest rates were going very high, and you can see where they are at 113 and 138. Their unemployment numbers were worse. Okay, their economic outlook wasn't as good as the U.S. They were being saved by Germany and France, more so Germany these days than France, huh? And so where did that end up leaving them? So one of the triggers that I would always look at is what was the 10-year Spanish debt paying for versus the 10-year U.S. Treasury. And there was a pretty significant difference, okay, when, last year, the year before. earlier this year, Spain's 10-year debt actually dropped lower than the U.S.'s in terms of interest rates. So, I go and I take a look at this, and I end up going back to, okay, when do I end up having problems? Okay, what's going to end up causing an issue in terms of taking a look at the SPX and what issue would end up triggering a sell-off? And I don't know. As I mentioned, I had been speaking to a number of these money managers that we do work with out of our New York company, and everybody is fearful, but they're not buying, insurance, and they think that, well, when the sell-off comes, I can just get out. Okay, I'll be smart enough to get out. And so, things that kind of scares me, and this is a John Malden line. I don't know if any of you guys read John Malden, but a really great free newsletter on a weekly basis. You can end up taking a look at, and he said he had a quote in his last book, Code Red, where he said, "He who lives by the crystal ball is destined to eat glass." And I kind of look at this, and reason why Mark and I started talking, it was like, Mark, you look at things at a lot shorter term than I do. How do you end up looking at this market, and what ends up keeping you up at night?
Well, Jim, that's a good question. You've been discussing a lot of macro points, and you're looking at sovereign debt, and you're making a lot of these comparisons. Just one thing before I get into some more details here, some technicals, just want to mention to kind of simplify what you're talking about, or I should say summarize, because you can't really simplify it. We had a situation back in 2008 where we had the financial crisis here in this country. Just imagine that on a greater magnitude, on a sovereign level. That's basically what we're facing here. And, back in those days, as we were talking about earlier, a lot of the signs were very apparent. They were there. You could have looked up this number. You could have looked up that number. All the signs were there. There was a guy named Nouriel Roubini who was not famous yet at the time, who was one of the loudest. He was one of the biggest, outspoken people that were basically talking about the problems. Nobody listened to him. What happened? Bear Stearns fell, and that was the trigger. Everything else was a waterfall from there, right? But all the factors were in place. Everything was lined up for that collapse, but nobody saw it coming, right? That's the funniest part, was everything was lined up, but nobody saw it coming. Only a few people. It's just nobody wanted to believe it was coming. Everybody was having a party. Everybody was complacent. We have a similar situation, I believe, from what we were discussing on a sovereign level, which is a greater magnitude. So if that triggers, the waterfall can be much bigger, because we're talking about on a government level, on a sovereign magnitude. So that's something to keep in mind. All these people that talk about, the survivalists buying gold and protecting yourself. I mean, who knows? That's a very extreme situation, but it's not something that you should ignore. Let's just put it that way. So, with that being said, looking at the S&P, I'm going to look at the S&P here. I want to share my chart. Let's see. Can I share my chart?
Yeah, Tom, can you, do I do it or do you do it? Do you give the ball to?
I'm a presenter now. Okay.
There you
Okay,
go.
so I should be able to
I just did. You should be able to share your desktop now, Mark.
Okay. I'm just looking for the button to do that. Let me see here. Just give me a second. There we go. Share my desktop. Okay.
Perfect.
I don't know if you guys can you see it? Oh, here we go. Okay. So what you're looking at here, is the S&P, right? Or actually, I have the spiders up right here. But what I'm going to do is I'm going to switch this to an SPX chart. Now, the platform that I'm looking at this on it's called TradingView. It's tradingview.com. It's a free website. They have their paid services. I'm not promoting them. But they're an excellent resource for looking up stocks and things like that. And you can get nice, a lot of back data and stuff. So anyway, looking at the SPX, there's a number of ways we can analyze this from a technical perspective, but on the big picture. Yes, I specialize in very short-term trading, so I'll be looking at little details in a situation way up in here for day trading tactics. But when you have a very broad view, typically what I'm looking for are levels first and then structures to confirm the levels. And anticipating levels is a very important part of my trading strategy. It doesn't mean I'm guessing and and I think I'm going to be right every time. I just know areas where I need to be very careful. And we're in one of those areas now. So let me show you. There are two schools of thought here that I'm going to apply. The first one is Elliott Wave. Now, Elliott Wave is not something that I actually trade by, but I use it to give me an idea, basically give me a sense of how I should form my thinking going forward, right? Not exactly making hard trade decisions. I have to refine my Elliott Wave analysis, and I use different techniques for that in order for me to actually take positions, especially on a short-term basis. But on the bigger picture, if I'm trying to get a sense of perspective, this is what I will do. Now, for those of you that follow Elliott Wave, there are two types of waves. So you have impulse waves, which are 5-wave formations, and you have corrective waves, which are typically 3-wave formations. So when you have a 5-wave formation complete, it's typically followed by a 3-wave corrective formation. When we look at this most recent upward move, right, from this, 2009 low to the current high, if I want to start counting waves, okay, I can actually count 5 waves from this low to this high. That would be what? My wave 1. So I can actually draw here, that's my wave 1, right? Now wave 2 is tricky in this case because it's what's called a running flat. It's A, B, and C, these 3 waves here, this leg, this lower leg, followed by this upper leg, followed by this lower leg. That is wave 2, okay, as you can see my little indication there, which means we have been in wave 3 for a while now. Inside of wave 3, I can count 1, 2, 3. Okay? So we are in a 3 of a 3, which means we're expecting a 4 and a 5 to complete wave 3, right? A 4 on this magnitude, a wave 4 can look something like this, right? And then we can have a wave 5. That would complete wave 3. And then that would bring us to what we'd be looking for is a wave 4. Wave 4 is corrective, all right, which can be typically a 3-wave pattern. Now, here's the thing. On this magnitude, there's something called proportionality. It's a tendency in Elliott wave speak, and it basically goes like this. If wave 2 is generally flat, which in this case it is here, then wave 4 will have a tendency to be sharp. If wave 2 is sharp, then wave 4 will have a tendency to be flat. Now, in this case, wave 2 looks generally flat here. It's not very sharp. A sharp wave 2 would mean a correction wave, almost retesting this recent low. That would have been sharp. This isn't sharp. So that means wave 4 is more likely to be sharp, okay, the wave 4 that we're expecting. Now, what can that look like? Well, we can actually do a simple Fibonacci retracement, right? And I can measure wave 3, the low to the high of wave 3. And I can look at the 382 retracement, the 38% retracement, right, which takes us back to 1606. We're trading at 1943 right now. That's one possibility. On top of that, that 1606 area also correlates, or I should say is related to, these 2 previous highs that occurred in the S&P. This double top that dates back to the year 2000 and back to the year 2007, both major market highs. You better believe that major resistance will act as a support, on the way back. So that seems like a good target area in terms of structure, okay? So if we do have the correction, that would be a decent target, and that can unfold in 3 waves, okay? We don't know exactly what they will look like, but that's a good target area, okay, as far as how deep the pullback can go. How is this information helpful to the medium-term trader or, the guy who's holding his stock portfolio? Well, when the market starts to correct, and the correction is accompanied by a serious catalyst, then don't expect it to get any better anytime soon. Like basically, if we pull back, we're trading at 1940, whatever it is right now, in the 1940s, 1950, right, whatever that is. If we're pulling back into like the 1800s or whatever, don't think that the party's over yet and this thing is going to return and go back up. That's the biggest mistake everybody makes. The correction can go as deep as 1600 or even the 1570s, back to this old high area. Okay, so that's something to consider. Now, let's change the school of thought here for a second. Right? That's the Elliott wave point of view. If we look at this now from another point of view, and this is more of how I analyze things on a shorter-term basis, what I like to do is use Fibonacci extensions to anticipate support and resistance zones going forward. When the price enters a support or resistance zone, I then look to validate using price structures, right? If I'm going to get short, I don't want to be the only one getting short, so I make sure other traders are there first, getting short, and that there's actually selling pressure there. But this technique that I use here allows me to anticipate those levels. Now, what I'm measuring here, okay, is this high to this low. This is the 2007 high to the 2010 low, right? That gives me a zone, a resistance zone, which we're beyond right now. Okay, 1580 to 17, what is this? Basically 1800. Okay, we're way beyond that, which is a very, in my opinion, very high risk area to be establishing any new longs or to be holding comfortably. Okay, so it puts us in a very vulnerable position. These resistance and support zones, like when I base them on this stuff, again, nothing is exact, but it gives me something to anticipate. So since we're beyond, this basically tells me, hey, if I'm going to buy and hold, this is definitely not the place to do it. These are really bad prices. You're better off looking for arguments to go short. At the moment, we don't have any. One thing I can do is I can start analyzing smaller structures to get a sense of when the selling can begin. And even when I do that using this technique, if I measure this small high, and these are weekly bars, by the way, this small high to this small low, we're even beyond even smaller proportions, okay? So I can't even find a resistance area of any kind of, that has any relevance to it at the moment. So what does that mean for my trading? What does that mean in general? Well, it means that this is a very high-risk area, at least for me. It's a very high-risk area to establish any new longs, but it's not ready to be wildly taking shorts. It's not ready. Remember, the market can be irrational more than we have money in our account, right? It can be irrational much longer than the money that we have. So if people believe it's going to go up and people are complacent, the market can just go, all right? There will come a point, of course, where there will be a correction. The key to this correction will be this. What is it accompanied by? If it's just some little minor news here and there, then that means we're still in this up complacent mode, okay? If it's accompanied by a serious spark, like Jim was mentioning earlier, that's when you have to pay very close attention, because the initial sell-off is going to be very telling of the rest of the structure, and that's when we can go back to our Elliott wave, okay? That'll give us a sense of where, how long the structure can go on for and where it can terminate, like, basically going back to that 1600 or 1570 area. That's how I'm looking at this. So we have really at this point, in terms of trading strategy, I would be extremely short-term in my views, and I would be working on the long side in terms of direction, because that's what the market wants to do. Like Jim said earlier, the path of least resistance is up. You don't want to fight the market. Let it do what it has to do. When the selling is going to come, it's not going to come all in one shot. It's going to unfold in waves. So you don't have to worry about missing anything. Let the market make the first move, and then we can adjust from there. We can figure out everything else from there because we'll have more information. Let everyone else figure it out. Don't take the risk yourself. That's what I have to say. So, Jim, I don't know. What do you think of that? How does this fit into your perspective?
One of the things, Mark, I like so much about talking to you is that your viewpoints and your tool bag is very different than mine. One of the things that I take a look at is that when you can take a look at things from different viewpoints and you get confirmation that the same thing's happening from a different set of tools, that makes me feel a lot more confident. And so, I'm looking at things like totally from a different perspective, but yet I'm coming out with the same exact conclusion that you are. So I feel really good. Like, for example, one of the things that I look at in addition is I look at how expensive not just the VIX is, right? I mean, that's a single number. I take a look and see, well, what do the VIX futures look like? What are they telling me? What are the below-the-money puts, the heavy-duty insurance? What's their implied volatility versus, let's say, the at-the-money or the above-the-money? By the way, that's called skew. Okay, and I look at history of skew. I take a look at history of the VIX and the VIX options and the VIX futures, and all of that is telling me the same thing. That right now there's not a lot of fear. I one time heard, and I don't know who ended up saying this. They said, my wife's a big fan of CSI. I don't know if any of you guys watch CSI, but the guy one time said to me, a trader one time said to me, if Wall Street was CSI, options would be DNA. Okay. And I kind of thought it was cute, and I always remembered it. And I said, oh, my God, it's so true. And what that DNA is telling me right now is that there's not a lot of fear. I mean, we can save this for another WebEx. I can actually go through what I look at and how I look at the options and the specific volatilities, but it's going through the exact same story that you just went through. And remember, the options, I'm sorry, go ahead.
No, I was going to say what's nice about your perspective is you look at these very refined inner workings or like the inner details, like you said, like the DNA, where, I'm looking more from like an external, looking at the price action, looking how traders are actually, allocating their resources or their money, and you're actually seeing, what's happening as a result in the internals, which makes this very powerful because, when you combine them and they're both saying the same thing, it's like, wow, that's a pretty obvious sign that, things are a certain way in the market because everything is confirming each other. Everything is confirming.
Yeah, I definitely see this is the same thing. It's and when I take a look at some of those, refined internals, as you mentioned, I always think about what drives whatever indicator or internals or any type of refinement, but what drives that pricing and those things. And the reason why I take a look at the option stuff, and I believe in that DNA quote, so to speak, is because it's how much risk managers are willing to pay to end up protecting their portfolio. So this is supposedly the largest, smartest money out there. And the other expression that I end up always loving is that because, let's face it, if Goldman Sachs needs to go and protect their portfolio, they're going to have an impact on the market. Okay? Elephants can't hide their footprints.
That's right.
You probably end up using indicators all the time and look at, things in terms of volume. Okay? Well, in terms of right, because basically anything that drives, whether it's implied volatility or options pricing or overall market pricing like the SPX, it's you have more buyers than sellers or vice versa. So right now we have a lot of buyers in the market and very few buyers buying insurance. Smart money will end up staying in the market but then also buy insurance. Right now they're tired of losing money because not one insurance bet has paid off for more than about 24 hours over the last year and a half. And that kind of ends up driving it. Tom, if you end up giving me back the ball, one of the things that I had mentioned before was the VXX, okay? And the VXX is, and I don't know if I shared yet, Tom, or you don't see me yet. Okay.
I gave you the presenter. You need to click share your desktop.
Okay. Anyway, one of the things that ends up happening, and we started talking a little bit about this. Let me just share my desktop first. Okay. One of the things that ends up happening is that we look at the VXX as a way to be able to buy the VIX. A lot of money managers, okay, and don't feel bad if any of you guys have done this. We know a $1.5 billion money manager who was buying the VXX as a way for protection. Mark and I were talking before it started. If you remember, we had a couple of days in early February where the market really got scared, okay? And the VIX ended up jumping, okay, pretty significantly. It was up, and this is what the VXX did. So it can end up moving up very, very rapidly when there's fear. And so they were trying to end up using this as a hedge. But if I go back, any period of time in this thing, let's say for a year, or if I go back a little bit further, let me go and take a look at it for, let's say, a 3-year period, you can end up seeing that this, sorry about that. Let's hit this button. You can end up seeing here that, yes, it can end up running up when we ended up having fear, like in the debt crisis, okay, where we ran from basically 400 to 950. But in the absence of that level of near panic, okay, this thing declines. And the reason why it declines, it's important to end up knowing. We were talking before, and there's no way to go out and buy the spot or the cash fix. Right? You can you can go out and buy the S&P 500. You can go and buy the SPY. Right? You can pick just about any type of if you wanted to, you wouldn't have to buy the Treasury futures. You could actually buy the Treasuries. Right? You can always buy the cash or the spot prices, but you can't buy the VIX. So the VXX was a rather poor implementation, albeit the only one that I could actually think of actually doing something even close to it, of buying the SP, to buy the VIX, okay, as a stock for the general public. So what was put out there is that they actually used the VIX futures to end up implementing this. So, for example, if you allow me a little bit of leeway with the numbers, the VIX is a 30-day looking forward, okay, insurance policy, if you will, right? It's a 30-day implied volatility on a weighted average of the options on the S&P 500, on the big contract, okay, on the SPX, okay. The way the futures work is that you could end up actually going out and buying VIX futures, and you can buy them out, let's say, 15 days and 45 days. I'm making those numbers up, right? They're not. It's not an exact month. But if you could end up buying half of your futures that were expired in 15 days and half of your futures that expired in 30 days, I'm sorry, in 45 days, your average would be 30 days. Therefore, it would be exactly like the VIX, because it's a 30-day looking forward implied volatility.
Mm-hmm.
But what happens tomorrow when your front future isn't worth 15 days and your back future doesn't have 45 days, they only have 14 and 29 days. Now, instead of having a 30-day looking forward option, okay, or future, you have a 29. So what do you have to do? You have to sell some of the 14 days and buy the 45 days. One of the websites that I think does a really good job of this, that ends up showing you this term structure, is VIXCentral.com, where they actually show you what the implied volatility of each of the futures are. I mean, it's delayed and you get your real data at the end of the day, but for a free site, it gives you a lot of information. And you can take a look at here and see, this is the way the curve normally is. It normally slopes down from upper right to lower left, not in a straight line, but more in a curved fashion, in a parabolic type of fashion. And the front months are usually cheaper. This bottom line down here is where the VIX cash is. Now, there's no real cash, right? So it's just the VIX spot. It's the calculation. And one of the things that the VXX has to end up doing is that they have to end up keeping in this case, the July and the August futures, and buy enough of them so that they average 30 days to expiration. that means every single day we have to end up buying this front month at to the July at 12.89, right? We have to sell some of those, and then we have to end up buying the August, because every day that goes by. And when you have this typical type of slope in the line, that's called contango. By the way, if it does slope up where it goes from lower right to, from lower right to upper left, that's called backwardation. So this number right here, this 7.68%, that's how much money, okay, you'll end up losing if you end up having to buy the second month and sell the front month, which they have to do over a full month, right? So that tells me that the VXX has a 7.68% drag every single month. So when you take a look at this graph of how the VXX gets crushed over time, it's bound to. The only time this ends up not happening is that if you end up looking like on a specific date where things might end up working out well for the way that the VIX futures end up looking. And what I'll do is that, you remember, Mark, we were talking beforehand that back in back in February, things started to get pretty ugly. So what we're talking about is this. Can you guys see this little blip over here in the big picture?
Yeah.
This blip.
I can see it.
What ended up happening was that we thought, the market's going to start to end up going down. So if I go back and I take the VIX Central and I take a look at historical data, this is the worst that it got. You can see the front month. Now look at what's happened here. You're selling the front month and buying the second month. You can see how in times of fear, this looks really, really good, okay, to end up owning this. So the question that you end up having is, well, how often does that end up happening, right? So what we ended up doing is that we did some work, and in a study that I'm working on, we did the following. I went back, okay, and we took a look at what the front month, that's month one, what the front month future looked like in terms of the VIX, and what the second month ended up doing. And what I did was that I built, okay, a little chart here, okay, and what we ended up doing is we took a look and saw what the level of contango or backwardation is. Now remember, the more positive number it is, okay, the more we're going to be in a normal situation, the more we're saying that the VIX or the VXX, okay, is going to end up going down. Now, when you take a look at what happened here since over the last 18 months, and I'll just go down. Remember, green means that it's going down, the VIX is going down, and the VXX is going down, and red means that, we have trouble, that we're in backwardation. Oh, we're in backwardation for a day. Okay, let's keep going down. I got one more day. I got one more day. I mean, you can see that other than, okay, a couple of days here and there, here's the one time when things got a little bit ugly. Right? Mm-hmm. They got a little bit ugly. But for most of the time, and I watch this constantly, okay, we're not seeing this level of fear. Okay, last time we did an update on the spreadsheet was back at the end of April. I haven't gotten May in there yet. But if I come back and I take a look at where we are today, okay, in terms of our term structure, we're in a normal environment. There needs to be some level of fear, and to me, this is the first thing that pops. This is the first indicator when we say, what's the event, or when is the event over, are people still afraid, is that I look and see how far out do the VIX futures go. It's a very simple way. If you're going to look at this, just on a daily basis, and you're not doing or even a weekly or monthly basis, you take a look at this, and it'll end up telling you where the level of fear is. And the level of fear it's important to realize how it's calculated. It's calculated how large money is willing to end up paying for options. And if they're not willing to pay for insurance, the smartest money in the world is dictated, it's not worth it right now. And
Right,
then
they're not scared.
I'm not scared. I'm not scared. So, I mean, I want to be scared. I have macro reasons to be scared, but you got to be in the
No one's
market.
taking the action.
I don't want to take any action. That's why, Mark, I like so much about taking a look at this from a shorter-term point of view in a place where we are. I think that your trading opportunities, okay, the way you look at things will end up giving a quicker view to when is this bull run going to start to end up turning?
Yes, and actually, Jim, on that, I can, Tom, if I can get the sharing back real quick. Am I still a presenter? I want to show you something. I am a presenter. Okay.
You are now.
Let me just show you something real quick. With back to my chart here. What I have here, what I wanted to show earlier is you just mentioned. It reminded me. You just mentioned, it's like where can this bull run possibly run out of steam, right? And how long can it take? Well, let me show you this. One thing about going back to the wave counts is there's this idea of proportionality where if you measure the first wave, the initial wave in the move, if you look at the 1.618 Fibonacci extension, when you measure the bottom to the top of wave 1, that typically will give you the termination point of wave 3, okay, typically. So if we're going to measure our wave 1, right, this is the low of wave 1, and this is the high of wave 1, right, look where my 1618 is, 2071.62 on the SPX, okay? We're still at 1962, so we have a little bit of ways to go before we reach a potential termination point, based on the wave counts, based on proportionality. So if that's the case, at least it gives us a reference point. It may not be exact. That's not the exact top. I'm not saying that. But at least it tells us there's a little bit more room for this thing to run. And that makes sense right now, especially just in light of this lack of fear, this complacent mode that we're in. We're in summertime trading, lower volume. There's no catalyst. There's no reason for this thing to sell. So why not float up there? It may fool around a little bit on the way up, but that's a good reference point going forward. I just wanted to share that with everybody. So I'm going to give this back to you, Jim. I just wanted to point that out.
Okay, thanks, Mark. I kind of gone through everything that I wanted to say during this. Mark, I really enjoyed this. Hopefully we can end up doing this on some type of a regular basis if there's interest. Would you be willing to participate going forward?
Of course, I'd love to.
Yeah, I think so. I really like taking more of the bigger viewpoints. I think that it'll end up helping, our community a lot to take a look at things. Tom, anything to wrap up with?
I don't think so. We'll have this published later today, and we'll send out an email to everybody who's on our list. So if you're watching this and you're not on our list, come to capitaldiscussions.com and get on the list, and you'll get updates in the future.
With that, thank you so much for participating today, Tom and Mark. I appreciate it, and I look forward to doing this again, hopefully next week.
Sounds
All right,
good,
Jim,
guys.
thanks a lot.
Okay,
All right,
bye-bye, guys.
Bye, everyone.